Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. Today I'm going to talk about something that is extremely important, and that is the Tax Cuts and Jobs Act of 2018. What am I talking about? I'm talking about tax reform, my friends, that is going to affect everybody starting in 2018. So what I thought I'd do is take a little time and compare and contrast some of the things that are currently in the tax law and some of the things that are changing. So let's get started. The first thing is on personal exemptions. In the current system, there's a personal exemption from each person that's being claimed on a tax return. Well, in the new tax rule, that has been completely eliminated. So that means that instead of getting, $4,050 for each person that's being claimed on return, that's going to be eliminated altogether. The next thing, and you've heard a lot of information about this in the press, is the standard deduction. So standard deduction is what is the option to take on the tax return if you don't have enough to what they call itemize your deductions. So let's talk a little bit about where that's going. The current tax system, for a single taxpayer, their standard deduction is $6,350. Well, under the new tax law, that jumps to $12,000. For a married filing joint husband and wife, for example, the current tax structure shows that at $12,700, and the new goes up to $24,000. So what they've effectively done here is they've eliminated the personal exemptions and made up for it with this increase in the amount of standard deduction. Well, that's fine if you don't have a lot of children or a lot of dependents. It won't really affect you that much. But if you're one of these taxpayers that may have 5, 6, maybe 7 children or multiple dependents, this may actually cost you a few dollars. The next area is in the area of itemized deductions, and there's some real key areas in this that we really need to talk about. The first one is that of medical deductions. Currently, medical deductions are deducted once you've reached 10% of your adjusted gross income. So for example, let's say that you made $100,000. Well, 10% of that's $10,000. So basically, you wouldn't be able to take a deduction for anything until you reach that $10,000 threshold. Now, in the new tax law, that threshold is going to be 7.5%. So that's going to allow us a little bit more deduction. Now, of course, with the higher standard deduction, I'm not sure we're going to get there. Now, this is the next area is taxes. Now, this is a one that's been bantered around in the press, and you've heard the term probably SALT, and that's state and local taxes. Currently, the current legislation is property taxes and state and local income taxes are deductible. You also can, for taxpayers not in the state of Delaware, you might deduct your sales tax. Now, in a compromise, what they've done is they've allowed the taxes to remain in place, but they've capped that at $10,000. So what this is effectively doing, and I'm sure you've heard about this in the press, is those folks who live in high tax states such as New York, New Jersey, or some of the higher tax states, this may have a significant impact on them. In fact, I got a call today from a client, and he lives in Pennsylvania. And in Pennsylvania, some of the property taxes are pretty high. So he said to me, Ralph, hey, how about I go ahead and prepay my property taxes? Well, unfortunately, the folks in Congress had already considered that, and they're not going to let you do that. So this is going to be one of those areas where if you're in a high tax state, you may see some reduction in your tax, your tax deductions. The next area is home mortgage interest. Now, the current law, home mortgage interest is deductible up to $1 million of acquisition debt. So what am I talking about there? What I mean there is that if your mortgage balance that you start off with is less than $1 million, you're basically entitled to take all of that as an interest expense in the year that you do it. You also are able to take second home and interest of $100,000 on a home equity debt. Now, here's where we see a pretty substantial change. Now, they're not eliminating the home mortgage interest, but they're bringing that acquisition down to $750,000 on the primary and secondary loans. Now, if you already have a loan that was granted before December 15th of 2017, this will not affect you. However, it is going to affect loans moving forward, and it completely eliminates the deduction for home equity debt. So my suspicion is we may see a very large push for people to remortgage, depending upon the amount of their mortgage. So, for example, if you've got a $200,000 primary mortgage and then a $50,000 home equity loan, one of the things you may want to consider doing is remortgaging to bring those two loans together so that you'll be able to deduct that interest that would not otherwise be able to be deducted with the new legislation. The next area is that of charitable contributions. Now, currently, and I get this question a lot, Ralph, how much can I donate? What's the maximum amount? I tell people this, they kind of chuckle. But right now, it's 50% of your adjusted gross income. Now, with the new law, they're actually going to increase that to 60% of of your income. Now, again, all of these type of itemized deductions, we have to consider that with the increase in the standard deduction, there may be, fewer people being able to take charitable contributions. So one of my main concerns, quite frankly, is are we going to see a decrease in charitable giving? So that's one area that I would keep an eye on. Next area, gambling losses. Right now, you can deduct gambling losses up to the amount of gambling income that you have. And that's not going to change in the new legislation. So for my gamblers out there, you're still in good shape. Now, the next area is personal casualty and theft losses. And I don't want to spend a lot of time talking about these because they can get really complicated. But basically right now, these are based on a 10% of income limitation as well. What the new legislation does is it completely eliminates them, except for those losses which are attributable to a disaster declared by the president under Section 401 of the Robert T. Stafford Disaster Relief and Emergency Assistance Act. So effectively what they're doing here, and I think this is a carve-out, again, for some of the people who were affected by the recent hurricanes and all that sort of thing, they're going to allow you to continue to deduct those. The last area is the Tier 2 miscellaneous deductions. What we're talking about here is miscellaneous employee expenses, business expenses, tax preparation fees, investment expenses, and casualty losses. In the new tax, that is all eliminated. So if you work for someone who doesn't reimburse you for your employee business expenses, this is going to be something that you're going to lose altogether. So that is a bit of a change. So that's something you want to take into consideration when you're considering those expenses. The final thing with itemized deductions is it does eliminate the phase out of itemized deductions. What am I talking about here? In the current tax structure, there is a deduction if you are if your income's over a certain amount, and it limits the amount of itemized deductions you can take. Well, with the new legislation, that is completely eliminated. So that will be something that will make some modifications to some higher income individuals as it goes along. We'll continue this shortly with some more information that's relative to the tax code changes.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.